On the panel are Michael Moro, Viktor Fischer, Ray Hindi, and the panel is led by Diana Biggs. Now, a little bit about Diana. She's Chief Strategy Officer of DeFi Technologies and former CEO of DeFi subsidiary Valor, the issuer of exchange-traded products providing investors with exposure to digital assets. In addition to her role at Valor, Diana is an associate fellow with Said Business School, University of Oxford, where she guest lectures on digital assets and blockchain technology. She's also a board member of Hive Switzerland. Please welcome Diana Biggs and her panel.
Great, thank you all for sticking with us. Already at the start of this month, total value locked in DeFi reached $250 billion. And over the past year, we've seen interest in DeFi increase exponentially, including from institutional investors. And so here to tell us more about what that's looking like, we have a fantastic panel who I invite to introduce themselves.
Hi, hello everyone. My name is Ray. I'm from L1 Digital. L1 Digital is a Zurich-based asset manager, fully focused on crypto. We invest in funds and direct investments into protocols, decentralized applications, and companies that provide vital services to the space, and we have a venture bias.
So my name is Viktor. I am from Rockaway Blockchain Fund. We are a VC fund, we have a fund of funds, and we have a DeFi fund.
Hi, everybody. Michael Moro, CEO of Genesis. We are an institutional-focused firm providing prime services, so trading, lending, custody to institutional investors, and happy to be here.
Great, so let's start with the question of why should institutional investors be interested in DeFi? Maybe it's yield FOMO that's getting them in the door, but how are you positioning the broader opportunity? Michael, let's start with you.
And everything I'll share is sort of color that I hear directly from our institutional clients, kind of towards their attitude towards DeFi, and kind of their level of interest and certainly kind of the rationale behind it. I broadly categorize kind of the institutional investors' interest in DeFi in like three different buckets. One, kind of the most aggressive are going to be kind of the crypto native hedge funds who are very comfortable interacting directly with DEXs and participating in yield farming and have operationally kind of figured out, the MetaMasks of the world and kind of engaged directly with the DeFi world. The middle bucket are the guys that are not yet comfortable to do it, but they want kind of the price exposure to the DeFi tokens. So that'll be guys that are just buying, Sushi or Uniswap or Aave directly from us. And we did about $1 billion, probably notional, across kind of various DeFi tokens in 2021 in terms of trading. Now, $1 billion, that's relative against, call it $150 billion of everything else that we traded. But that kind of gives you the scale. That is, while it's not nothing, it's still small, kind of compared to kind of the Bitcoin and Ethereum. Then there's kind of the last category, are the traditional institutional investors. And frankly, those are the guys that are still trying to figure out what Bitcoin is. And so they're comfortably in my not going to make it bucket. It's lazily, they're my NGMI friends. No, and they're sort of like gray areas and kind of hybrids in between, but that's broadly the way to kind of think about where institutions are. And so it's probably helpful to focus sometimes on subsets of institutional investors and kind of their attitudes and why they're participating and frankly, why they're not participating in it.
So when I speak to our investors, we have 52 investors, I see primarily, so they have a bank account at Julius Baer and they pay minus 0.75% on the current account, yeah? And through DeFi, we are able to generate, I think, around 15.4% currently annualized. So definitely it's return, number one. Number two is also different risk profile because in traditional credit, you look at the P&L at the balance sheet. Here in DeFi protocols, you do not have a P&L, you do not have a balance sheet. You actually have, we'll talk more about risk later, you have a protocol risk, maybe you have a stablecoin risk. So that's second. And I would say the third reason is, Bill Tai previously in a panel, he mentioned that 5 billion people live in underdeveloped countries. And actually, thanks to DeFi, they can, for example, trade stocks like Apple stock using platform like Miro on Terra. And I'm not promoting a project we're invested into, but we are. And you know, people in India they don't have to open interactive brokers account. They can just, through their wallet, connect to Mirror protocol and buy Apple stock if they wish.
So what we see on our side is, and trying to add to what was said by Viktor and Michael, is that we're starting to see interest from traditional investors, so institutional investors being family offices, progressive family offices, that are simply looking. I mean, today, if you look at where we are in traditional markets, there's a natural demand for a strategy that offers you premia, and that by definition has a high Sharpe. There's always been demand for that. And from portfolio construction perspective, just very simply, they're very interested with credit markets and spreads being extremely tight, which reflects what Viktor said, but tight across the curve. They see that there is a premium to be offered out there. But as Viktor mentioned, the risks are unknown, and there's a lot of catch up from a knowledge perspective to get there. And unfortunately, we haven't seen them move in yet, but we expect them to start moving in pretty soon.
So are we still in a testing phase, and it's sort of like this is a new experiment for them, or what are the offerings that they're currently going after, and how are they positioning that from within their overall portfolio mix?
So I would say, as Michael said, there's no chance for them to interact directly with protocols, because you need like your credit analyst at your family office or your traditional fund doesn't have the skill set nor the knowledge, nor the network, nor the information to be able to assess the risk on the DeFi side. So their only chance, and that will frankly apply for many years to come, is to use service providers. Service providers in the form of crypto finance firms or actual fund managers that provide those strategies. And so essentially they will need agents to give them access to that premium and risk manage it, essentially. So, even if they can test as much as they want. It will take years for them to catch up from a knowledge perspective and be able to navigate the craziness that's taking place within DeFi.
Yeah. Michael, are you seeing that as well in terms of like what type of demand specifically for products or services that they're looking for now, and how that might be changing over time?
Yeah, I think, I 100% believe we're still in the experimental, stage of DeFi. I think everyone else, even on the retail side, I think, understand that like things like UX, UI could be a lot better for like more mass adoption. And I think we're still kind of in the process of figuring out what that looks like and how that ultimately evolves. What Ray was kind of referring to for like true like institutional investors. One of and Viktor was talking about risks earlier. I think one of the reasons is, all right, something goes wrong, I need to call somebody, right? Who do I call if something goes wrong on a trade? And frankly, one of the features of DeFi, certainly it becomes like a bug for regulated institutions, for truly like institutional investors. And I think it's one thing when you're putting your own capital into it. It's quite another when you start taking your client's money into something. I think the level of fiduciary responsibility is that much greater when you're putting in third-party funds. And the inability to like sue somebody if something goes wrong is definitely one of the things that are keeping the more traditional institutional investors out of it. However, I do think that their interest, while they might be drawn in, by the high yields and high returns, I do think they have genuine interest in kind of the possibilities of open finance, like directionally how we can kind of make finance better and kind of bring finance into like this millennium. And so I do think that from a curiosity perspective, I think it's definitely there. Whether or not they're ready to actually put money on the line, for most traditional investors, they're definitely not there yet.
Yeah, And I would echo that, and I would say, it's not. Initially, we thought, we would leverage our VC analysts to also do like DeFi protocol due diligence, but it turned out to be, we had to hire a completely dedicated team of 5 people, and also we had to hire like an IT team because like custody is so much more difficult. Yeah, how do you generate yield actually on DeFi? It's number one, you get the underlying yield from the DeFi protocol, like lending protocol, number one. But number two, you also get a subsidy of the token of the protocol you are using. And, and you have to be able to combine those two, plus those protocols. The earlier the protocol is in its lifetime, the higher the subsidy it gives you. So, for example, I don't know, we have exposure to Sabre on Solana, which was released, 1 year ago. Before investing, we had to run like a smart contract audit by, professional white-hat hackers. And so we completely underestimated the complexity of investments.
Okay, interesting. So what do you think are the missing pieces in the ecosystem now that will allow for more institutional investors to move into the space?
I mean, I think it's going to be around service providers, to be fair, because I could be completely wrong, but I don't think that institutional investors or traditional institutional investors will interact with those protocols for a very long time. Because they don't have the knowledge, the skill sets, unless they start building DeFi specialist teams in-house, it's not going to happen. So essentially, the service providers are the ones that are, first, I think there's going to be, there's going to be a lot of funds that will launch soon just to tap into those opportunities with specialized teams, with specialized systems to assess those risks. And of course, there's there's a big element, which is the regulatory side of things, KYC and AML, that needs to be covered. And those are, so you need many service providers to cater for those institutions, essentially. And I think it'll happen through service providers.
Yeah, I would say there's so many things to improve. So also like the amount of collateral, yeah? If I want to, so half of the DeFi, half of the 250 billion is actually lending. Yeah? If someone wants to borrow from a protocol, they have to put a collateral, and it's roughly 50% loan to value, which means that every position you have has to be like over collateralized. Yeah? So in traditional world, it does not really make sense. Yeah? If you want to borrow money to buy a house, you don't have to put down twice the amount of your house. And there are some projects like Teller Finance who are trying to solve this. But I think, building on what Ray said, KYC on the users is going to improve that, because then you know who is actually borrowing from that protocol, you know their credit risk, etc. So that's another idea.
Look, I agree. I'm of the view that the traditional institutional investors are never going to directly interact with a non-AML KYC protocol, like period, like full stop. So for them to ultimately kind of get involved, it's kind of the permission pools, certainly kind of the KYC to AML, and that's the way Genesis today has been interacting with various DeFi protocols, and whether that's like helping, kind of starting to get involved in the Aave ARC project, or, using like Maple Finance to kind of borrow and lend in a DeFi world. But you're doing it with counterparties you've already screened and figured out the credit work. And so it's just like kind of the operational stuff that you're kind of using the platform for. So I do think that the future is going to be then, once you create gates and kind of create AML, KYC, ring fencing type of stuff, the cost is liquidity, right? Like retail drops off, and then it's all a matter of, okay, but if that like reducing the liquidity pool only means that there's only like 10 people that show up, then it's not really all that valuable, because chances are you already know those 10 other people, and you can do this like off the platform. So then the question is, how do we increase the number of participants that you otherwise may not have interacted with? And that's the true value, ultimately, of what I think of how DeFi for institutions will ultimately play itself out.
I think two more things which I think need to be improved as I think about it. One is custody. it's a complete hassle to do custody of DeFi protocol. So, you know, our bank on the yield fund is Bank Freak. They are amazing, but they cannot custody, you know, Saber on Solana or Anchor protocol on Terra because those protocols are new. So, you know, we have to have like an internal solution, you know, combining of like hot storage and cold storage. Doing a transaction takes, you know, a couple of hours or a couple of days, depending on the complexity. Like my dream is to have like a fully online multi-sig solution across different chains. If someone is able to program this, like I would invest by, that would be amazing, yeah.
And also, I would say that we're talking about plain vanilla, strategies that have a premium attached to it. But when you think about it, you're trying to bootstrap a financial system, a new financial system, which means that the reason why the premiums are there is that there isn't enough USD liquidity, and it's related to demand for crypto. And essentially, you're building a financial markets from scratch, which is very complex, and there's a liquidity is segregated across venues. So if you really want to do it properly and you want to extract a decent amount of premium, you need to be set up like a super sophisticated arbitrage manager. It's like structured products on steroids, basically. And so, which means that with this space evolving continuously, the complexity is enormous. If you really want to do it, be set up properly and continuously extract premium from it.
Given the complexity and the specialized skills, who do you see as the players that are winning in this? Or how long do you think it will be before we're able to actually accommodate the potential interest from institutional investors?
So our interest is still coming from high net worth individuals and family offices. So we have a VC fund. We will not be calling, 100% of our capital. So, we just suggested for our investors to kind of park their money until we launch the new VC fund into this yield fund temporarily. So they use it as kind of like a yield generating parking spot for their money because they have 1 month redemption period. But, those are not institutions, not pension funds. Those are family offices and high net worth individuals.
Yeah, look, I think one of the things that we haven't mentioned yet is insurance, right? Like as far as things that could be improved to get more institutional investors and frankly, other people just kind of involved more in the DeFi space. And all the rug pulls kind of make all the headlines, right? And every time something happens, we'll get a call from some fund. What happened here? What was the risk? And all of it. And it's like, how do you prevent that? And then it's like, well, do you have a smart contract auditing team in-house? And no one does, frankly, at the traditional firm. So I do think that, well, insurance, I think, is an issue across all of crypto, not just kind of in DeFi. But I think innovations in insurance, I think, can go a long way to at least providing investors some level of comfort around the legitimacy ultimately. Otherwise. And the other point regarding legitimacy is the retail investor tends to, kind of the concept of yield farming and kind of find the highest APYs and kind of hop into that farming pool and then continuously seek the higher one. In traditional finance, as you all know, the higher interest rate means higher risk, right? So you actually don't try to necessarily find the highest gross interest rate return. You're thinking about it on a risk-adjusted return basis. But like no one has, how do you calculate that risk premium to really kind of do a risk-adjusted return basis? And in a way, and this is counterintuitive, I'm actually of the view that APYs coming lower will actually legitimize the space for institutional investors. I think they have a hard time taking things seriously when APIs are like 1,000% a year. You're like, what is this thing? And if we actually got it down to a more like reasonable level, and we can argue about what reasonable interest rates in DeFi might ultimately be, but I do think that kind of the outsized APYs has a counter effect on institutional investors as far as taking that platform seriously.
Yeah. No, I completely agree. So we don't do the crazy stuff like Olympus DAO, 6,000% Ponzi schemes, yeah? But we do only basically stablecoin to stablecoin, market neutral strategies. But during the real bull market in summer, we had like 22, 24% annualized. Yeah, investors were like, "Wow, like how are you able to do that?" So we had to like decompose and say there is an interest part of it, and then part of it is tokens that we are getting as a subsidy, and then we sell them. and right now it's kind of like a bear market for some people, although we we went through some other bear markets before. And but right now we have 15% annualized, and discussion is much easier.
Interesting. And so as we are moving into the year, when you're having institutional investors coming to you, they've heard about DeFi, they want maybe to try it out and to get involved, what are you considering to be the most interesting opportunities or the avenues for them to do that?
I mean, I think, I think when most investors look at crypto as one bucket. So the question today is, do I get involved, yes or no? And I think they're slowly realizing, or I expect them to start realizing, that crypto has become very vast. And being invested in crypto, there are so many strategies that you can apply in crypto. And I think there are some smart investors that are starting to understand that you can start applying your 60-40 model in traditional markets in crypto as well. So as Viktor said, today there are investors that maybe invested 12 months ago into crypto, made very decent returns. And while they want to stay involved and they see that by providing liquidity to a system that is being built, they can earn premia, they can also eliminate directionality, which gives you that fixed income component within a 60-40 setup, right? And so I think this is what could be interesting in this year for investors as they start diversifying within their crypto bucket across other strategies as crypto gets vaster and vaster, giving you many opportunities for diversification within that bucket.
I would say, just try it yourself. I was asked not to do a tutorial today, but we have a workshop tomorrow. But just use Anchor protocol. You got a ledger for free from Pascal. If you're part of this conference, just use a ledger, put some USD there through FTX or Binance, and put it in Anchor protocol for like 19% annualized, and then just start playing with it.
I'll agree with both my colleagues here. I always believe that doing something yourself is the best way to learn how things work. Probably not just true in crypto, it's probably true in other things, but certainly as I was learning Bitcoin, 8-9 years ago, I think the best way is to create your own wallets and figure out how to do this and send and receive some transactions, and you kind of like get it, and kind of a light bulb kind of like clicks in your head. And so I do think it's worth kind of spending some time to kind of figure this out. I'm also with Ray that institutional investors are just going to say, hey, you know what, I can't deal with this. I want to do it, but I don't know how, and I don't have the time to kind of like figure this out, and so you do this for me. I do like managed services guys and managed money managers kind of that are strictly allocating to strategies within DeFi, I think is a huge opportunity. And I think there's lots of guys who want to do this, but just can't really be bothered to kind of figure this out. And so I do think there's plenty of opportunity for sort of more actively managed DeFi strategy as certainly an opportunity for institutional investors.
Great. So we have time now to open it up to audience questions.
Hi, this is Nag. Just have two questions to the panel. Do you think like protocol default swaps to actually hedge against protocol failure, is it something possible in the future in terms of hedging the protocol failure risk? And second one is, the velocity of the money is much faster in crypto compared to traditional markets, right? So I give 500 Bitcoins to Celsius, he gives to Aave, Aave puts another protocol. That's why the APYs are higher. So do you really think the current size, 250 billion, is actually the real size, or it's much smaller? What are your comments on that?
I'll try to tackle both. I mean, total value locked is difficult because I think there's probably some double counting kind of happening, right? So, we can probably argue about what the real number of total value locked is, but we'll go with the 250 because that's like a nice round number. As it relates to protocol default swaps, it's funny, like we're talking about DeFi and like this is looking a lot more like CeFi and kind of like traditional finance as we figure out the services and products. At the same time, I feel like that is like you could pretty easily game that, wouldn't you? Like you could, if you're a developer of a particular protocol, you could probably potentially cause your own one if there's enough money in it for yourself to get paid out in the default swap. Ultimately, who's selling it? Because I'd probably buy some. So then it's a question of who's kind of providing liquidity for that marketplace to kind of do it. Could that potentially solve it? It could. I'd certainly be interested in kind of seeing a market like that ultimately develop, but I don't know who the first liquidity provider to provide default swaps against DeFi protocols might be.
We saw some projects doing something similar, like Opium Finance, but it didn't really take off so far.
Hi guys, Patrick Horseman. Can you guys comment a little bit on DeFi 2.0 and kind of protocol-owned liquidity and how that's going to change your strategies in the market in general?
That's all you.
It's not my area of expertise, and protocol-owned liquidity. We are not doing that.
So what we're doing is that, again, same thing. We're dedicating this to specialized managers because since we're focused on the venture side, you need specific setups to manage those risks. So yeah, we've dedicated that to specialized managers.
We're done.
Okay, then we can wrap up. Thank you very much, everyone. And thank you, audience.
And thank you, Diana, for a terrific panel. Thank you very much indeed.